Hello, everybody. This is Chris Noggle, and welcome back to the show. I've got an awesome guest today, one that is right in line with the money side of the real estate money school. So I've got Ken Gee with me from KRI Partners, and we're going to dive into what Ken does, what his company does. And just a real quick highlight, they manage thousands of units, but it's not so much what we're going to talk about is the units that they manage. We're going to talk about the fact that he's a CPA, a commercial lender, and he's a commercial broker, but they don't buy or sell with the brokerage. So this is going to be a really fun one. But before we get into Ken's story and talk all about this awesome money stuff and the real estate benefits that they help people with, but we're going to really get into you and your journey to becoming a rebel banker. Your journey is going to start with things like this podcast. It's going to start with you reading books and getting knowledge in YouTube, but all of that is just noise if you don't do the single most important thing with knowledge, and that is apply it. Whoever said knowledge is power simply lied. Knowledge isn't power unless that knowledge is applied. So I need you to listen and take out 1 to 2 golden nuggets from this podcast episode with Ken. And I need you to apply that. So here's how application works. How about I test your skills? I'm going to give you something for free. I'm going to give you a book, Drifting Away from Traditional Car Buying. This is going to teach you very simply how to get all the money back for every car you will buy, drive, and own. And all you need to do to get that book free is take action. So what is that action? Go to chrisnoggle.com, one swipe of the index finger, and right there, it will be the free book. Click the book, give us your email. We'll send you the book, and boom, that is how you apply knowledge. I gave you knowledge, and that knowledge is hidden in a book. And to get the book, you have to do something. It doesn't cost you anything this time. So what you're doing now is you're investing your time with doing that, which I think time is the most valuable thing because it is priceless. But the next step in your journey might be investing money. Successful people invest time and money. Ken didn't get where he's at without investing a lot of time and also money. So folks, in your journey to becoming a rebel banker, that is the key. It's not the knowledge, it's the application. So Ken, welcome to the show.
Thanks so much for having me.
Absolutely. I am really excited about this show because we were talking a little offline about your background, and it's awesome. I mean, number one, I'm always seeking out CPAs. I just love CPAs. I love the knowledge. And especially right now in this current environment where we certainly know we might just be at the lowest tax bracket we're ever going to be at, CPAs are my best friends. But you're not just a CPA, you're also a commercial lender. And that's a lot of what we do. We lend money. That's what we are. We're the bank, just like my hat says, BYOB. And that doesn't mean beer. That means be your own banker. So I think we're going to have a lot of fun talking. But Ken, I don't want to tell everybody what you do. I'd rather have you just tell us a little bit about what does KRI Partners do?
You bet. So we specialize in multifamily real estate. That's all we do. Excuse me. We used to syndicate. So that means we would go out, find a deal. Central Northern Florida is where we operate now. We would go find a deal, lock it up with our own money. Then we go out and raise the money, close the deal, and share the wealth with our investors. In a competitive market like Florida, that's a tough deal because it's hard to get the deal because everybody else is syndicating. Every seller you talk to has to believe that you can go out and raise the money. So instead, what we did with our last raise, we flipped the model. So we raised a blind pool fund. That's the generic term for a private equity fund. So what we do now is we raised about $13 million in that first fund. And now we're out deploying that capital in the apartment world in Central and Northern Florida. As soon as we wrap up our deployment here, which we hope to have done here by the end of January, we'll be on to our next fund. So that's primarily what KRI Partners does. We're vertically integrated. We also manage properties for ourselves as well as others, but that's it in a nutshell. Basically, our goal is to help our investors build wealth through passive investment in real estate.
I love that. Did you notice what he just said in that final thing, folks? It's a very important thing. If you're an entrepreneur or you're on this journey to becoming an entrepreneur, the number one thing he just said is, what problem does he solve for the people that he helps? That is what we all do. Every business that is successful, notice how I said every business that's successful does one thing and one thing really well. They solve other people's problems. And that's what all of you need to do. But Ken, there's some things I want to unpack in there. Just being from the money space over 20 years in the stupid Wall Street world, and thank God I'm not there anymore. But you're talking about a fund. When people, the average person, and maybe some of the listeners on this show hear fund, the first thing they think of is, oh, you mean like Vanguard or like Fidelity or like T. Rowe Price. They think of a fund as an open-end fund where, they just invest their money and then they share in whatever the ups or downs of that fund are based on market movement. But you're talking about a blind pool fund. And now all of a sudden, people just need a better understanding of what is a blind pool fund, because these are becoming more popular, although I wouldn't say talked about a lot because it's misunderstood. What exactly does it mean to raise money? And for an investor, how would an investor come into a blind pool fund and what's in it for them?
Yes, sure. So the best way to understand what a blind pool fund is to let me go back and revisit how we got there, because that's the most important thing. You hit it on the head. Our job is to solve somebody's problem, right? And so in order to, in our world, that means find deals that we can invest with our investors so that we can all create wealth. That's our objective. So we're in a very competitive market, Central and Northern Florida. Everybody knows that. It's a crazy market, right? So in the syndication model, that's the one that most people are familiar with in this private wealth, this private money space, right? We're not registered with the SEC. This isn't an IPO. This is very different. It has special rules that we have to follow and special criteria that it takes in terms of somebody's financial abilities to get into our deals. But let's go back to the syndication. In the syndication, you have to go find the deal. If you're the sponsor, you would negotiate the deal. You convince the seller that you're going to be able to raise the money, and you put some of your own money in and just start the due diligence process. As soon as you lock down that deal, you've got to rush out, and you've got about 60 days to raise whatever capital you need to do that deal. So that's, for the sponsor, that's a pretty stressful event because you've got a short window and you better raise the money. If you don't, you're going to lose money and you're going to be in a bad situation. It's very difficult to get deals in a very competitive market if you're a syndicator, because everybody else is syndicating as well. They're doing the exact same thing. So like any business, you got to find a way to differentiate yourself. So what we said, we've been doing this now for 23 years. So we have enough experience and we understand what we're doing. We understand why we're doing it. We've got a great track record. So now we decided it was time to flip the model and give us that competitive advantage we need in a market that's very competitive. So now we created this fund. It's no different. We already defined we're going to go after BC class value add deals. It's going to be in Central and Northern Florida. We're going to target annual returns of 15%. It's going to, we define the whole terms of the fund, and then we go talk to folks and say, look, this is what we've done in the past. Here's our track record. Our existing investors have followed us. And do you want to be a part of this blind pool fund? Now, what that means is that they make a commitment to invest, say, $100,000. In our case, the minimum was $100,000 to get into the fund. So they'll make a commitment of at least $100,000, and we will then go find assets that meet the specific criteria that we've already promised that we would follow, and then we go deploy that capital. So we call the capital as we find the deals. Now, that's a good thing because that gives us a competitive advantage in that market. Now, when we approach sellers, now when we approach brokers, they know there's no equity raise risk anymore because we've already raised the money. They know how much money we have. And so every broker wants the deal to close. They don't ever want to have to be in a situation where the buyer backs out and then they got to take it back out to the market. It's just a bad situation, and that just destroys their trust with their client, which would be the seller. So we're a pretty low risk buyer for a lot of reasons. One, we already raised the money. Number two, most people that do blind pool funds, they have to have some level of experience or else people wouldn't agree to give them the money, right? You have to have proven yourself that you can do this successfully before people will, quote unquote, give you a blank check, so to speak. So we're really efficient through the buying process. So because of that, we'll call it a preferred buyer. That's not how they refer to it, but that's the best way I can think of it. And so now when we go to compete for a deal in a competitive market, we have a leg up. We have differentiated ourselves in a big way. And so now we're able to get maybe not better deals, we're able to get the deal, right? Then it makes sense and we're able to close efficiently. So that's the blind pool model. And it's most important to understand why we do it that way. And so for the investor, it's really no different than being in a syndication. The huge benefit is you're going to get a little diversification inside that fund. So in our case, as soon as we raised enough money that we were comfortable, we found our first asset, we closed the fund. Nobody else is allowed in. It's roughly $13 million, and we're going to deploy all that capital. So everybody knows what percentage they're going to get of every deal that we put into the fund. So now the investors get a little diversification inside that fund rather than go to 3 or 4 syndications. They get that diversification inside the fund. Does that make sense?
It makes total sense to me. Now, one thing I want to kind of go through there is the blind pool model. You're getting interest of investors or letters of commitment from investors to invest in the project based on the stated terms of, this agreement that you come up with. So you're not actually taking possession of the funds until the deal is secured and the money's ready to be deployed. And so does that mean
Correct.
The money goes directly from the investor into escrow to close the deal? You never house the money, escrow the money. So that's how you skirt around. And it's very, folks, I don't want anyone listening to this being like, I'm going to go create a blind fund. Listen, like, you do not want to just go create a blind fund. Find yourself a good attorney, a good CPA that understands this, because otherwise SEC, you don't want them knocking on your door. You don't want them coming saying, hey, what are you doing here? Because I promise you, they do not play nice. And I promise you, you can't win against the SEC. So by not housing the money, by not holding the money, you don't have to deal with some of the regulations and some of the pieces there. But when you're going to these investors, one other thing I know that's a slippery slope is, how do you market? Like, is there rules with marketing in a blind pool fund when you're going out there? I mean, can you do luncheons? Can you go to non-accredited investors, or is it strictly accredited? Meaning, do they have a certain level of income and net worth that qualify them under the guidelines of the government as an accredited? So what are some of the rules that come into this blind pool?
Yeah, great question. So there's 2 exemptions that most real estate people will go to. There's a 506B exemption and a 506C exemption. We've always relied on the C exemption. I'll tell you what that means. That means that we're allowed to go out and solicit and talk about our next funds, maybe even on this podcast. We're allowed to market our fund as long as we do a number of things. We have to file our exemption with the SEC. We have to file all of our state they're called blue sky filings, and make sure that we're registered in all the states that we're operating in and raising money in. And we're only allowed to allow accredited investors in the fund. So that means you have to meet the SEC definition of an accredited investor. And that is basically a 2-pronged. There's a lot more definitions, but
there's a simple way though.
Yeah, the basic is $1 million net worth exclusive of your home, or $200,000 for the last 2 years in income, or $300,000, and you expect to repeat the same this year, or $300,000 joint with your spouse. Now, the SEC requires us to take that a step further, right? Because somebody could just say, yes, I'm accredited. Here you go. Here's my money. But the SEC doesn't let us do that. We have to take steps to verify that you are, in fact, an accredited investor. Because when we do all of these things, we're allowed to now outwardly market. We're allowed to put our offering on the internet. We're allowed to email. We're allowed to do whatever we want to do. We could even do radio and TV ads if we want to. We don't do stuff like that, but we could if we wanted to. Now, when you go back to and I'm not as fluent in the 506B exemption as I am C, because I've never done a B, but with the B exemption, generally that accredited investor rule isn't as stringent, but you are not allowed to solicit.
So that's
you are not allowed to market. You have to have a pre-existing relationship with anybody that you talk to about your deal.
Absolutely.
And so and then you're allowed, I think, up to 35 non-accredited investors. I could be wrong on that. Again, we don't do B exemptions, so I don't know that one quite as well. But that is the differentiation. Now, whether you're doing a blind pool fund or a syndication, the exemptions are still handled the same. And so don't worry too much about that. But you've got to really you've got to get a securities attorney involved early on, because like you said earlier, Chris, you don't want to screw up these rules, because the last thing you want to do is to have the SEC knocking on your door.
And Ken, that's why I wanted you to explain it, because I think, in this world, a lot of people, realize that there's a lot of money out there in the system right now. I mean, the government printing $5 trillion flows into different, pools and ends up in people's hands where they then want to invest it. And it is easy to raise money in comparison with any other year that I've ever been in the business. But if you don't understand the rules, do not ever, like, I have people all the time that I see on Facebook and Instagram saying, would you like to invest, paying 10% interest? Like, you are literally You are putting a bullseye on your ass. Like you are getting yourself in trouble that you have no idea what kind of trouble you're getting yourself into. And I love how you just define the two. So the way that you're doing it, with the exemption is different than the way we do it. We do it with just friends and family, or quote unquote, the friends and family rule, where we don't market at all. None of the 5 funds that we've raised for, we've never marketed. We go internally. We only speak to people that we know, like, and understand, and that they know, like, and understand us, friends and family. And, then we don't even, there is an exclusion for how many non-accredited you can have. And I don't even go after non-accredited. Every time we had a Reg A fund that we did, one of the first ones, and it was the biggest pain in the butt of any fund I've ever had, because, when you don't have rules for engagement or people investing, you get people that sometimes maybe they say, hey, I'd like to invest 10 grand. You don't know if that's the last 10 grand they have. You don't know if that 10 grand was supposed to pay their rent for the next 6 months. They might put it there in the expectation of earning a big return, seeking unrealistic returns in their mind. And then all of a sudden things don't work, or it takes longer, then they want their money back. It was a nightmare, and I'll never, ever, ever do another Reg A. But not getting into too much about the funds, I appreciate you explaining that. And one thing I want to talk about there, folks, is it was very important for you to hear that journey for Ken, because he's built a company around these different criteria. But I'm safe to say, Ken, that you're not the only person doing everything in your company, right?
No, I'm not. We have about 45 or 50 people on our team.
Yeah. So when you're building a company, you have to understand that you're going to have a level of expertise, but as you grow and as you start doing things like raising money through blind pools or everything else, or getting into syndications, you're going to need people that have expertise, and that expertise should come in the form of wisdom, and wisdom is typically time. And when you look at the different ways of building your team, I always love, the Henry Ford story, because he had a 5th grade education and he built Ford Motor Company. But when he was on the stand in court being questioned, are you fit to run a company of this size? He said something genius. He says, you know what? I'm smart enough to know I'm not smart enough. I have, and he doesn't do it this way, but this is how my visual mind does. He has a row of buttons with people smarter than him. Ken is a CPA, and Ken has other people that are different professions or different experts in different sides of his business. So in other words, Ken's got a row of buttons too, that when he needs somebody, he knows what button to hit for someone in his organization that is smarter than him in that particular area. Don't be a jack of all trades. Don't think you know everything. And please don't go out there trying to raise money when you don't understand the rules set forth by the government and the SEC. It will end poorly. Well, I'm not even going to go there, but don't do it.
It will. And if I could just add one more thing to that, Chris, and just absent the actual rules, one of the things that we spend a lot of time on is making sure, and you're a money guy, so you'll appreciate this. We try to make sure that the investors that come into our fund, their investment goals, their expectations are in line with real estate investing and what we think we can deliver. That's really, really important to us, because even in our real estate space, if you're doing a value add 3 to 5 year hold and then you're going to sell the asset, that's a different objective than somebody else in the real estate space who's maybe going after class AA, class AAA stuff. They're going to hold it for 7 to 10 years. Maybe refinance it at that point and get some of their money back. It's a longer term strategy. So my point here is that we're very, very careful not to just follow the rules, but to just think for a minute about you're dealing with people. This is a relationship you're starting with an individual that's no different than any other relationship you have in your life. Just because they're an investor and we're the sponsor, we don't pretend like it's not a human relationship, because it is. And I want to make sure that their goals, their expectations, what they think, why the reason they're doing this matches, because the worst thing you can have in our world is a mismatch. They thought they were going to get this, but that never matched up. And I do my best to vet that when I have investor calls, because it's important. And we want a meeting of the minds. That's what's really important here. And I know you didn't ask that question, but that's the real human side of what we do that you really can't lose sight of above and beyond the rules.
Well, it's super important because, I know, we talked about solving people's problems, but you have to understand what is the problem you're solving. And is the thing that I do, commercial real estate, syndications, blind pool fund, whatever it is you're doing, is that in line with the client's objective and the client's problem that you're solving? If it's not, well, then find a different way to solve that problem, or simply learn to say no. That's a big thing that a lot of people have. It's almost like a lost art, is the art of actually saying no. telling somebody no allows you to say yes to the right things. Telling yes or someone yes to everything just because it's a feel good and you want to try to help them is probably one of the worst things you can do for them, because you're saying yes to something that's not in line with what they want. So I love that you described that, because we do have to get really good at listening. And we have to get really good at the questions we ask people when we're trying to solve a problem for them in any capacity. I mean, here we're talking about money and real estate, but if you don't know what the client wants, if their objective is a 1-year deal where they're going to make 10 to 15%, and your deal is a 3 to 5 year deal where they're going to make 8 to maybe 10%, you're not in line. And then what you got to have is a coming of the minds, if you will, and say, hey, here's where we're at. Here's where you're at. Is this in line? And they have to then say yes or no. It's very important, because boy, oh boy, don't get into a deal where somebody's thinking they're getting their money back in a year, and then all of a sudden it goes 3 to 5 years. Not going to be a pretty story. But let's go the next step on this, the commercial lending side. So we just talked about how you raise money and how you've acquired thousands and thousands of units, and in one of the, some would argue, the hardest markets in this country right now. And that's not going to change anytime soon, because I'll tell you what, us New Yorkers up here and the Californians, we don't like where we're at for the most part. And if it wasn't for family, I'd be in Florida right now, and it's just going to keep driving the markets, or at least we think. So commercial lending, let's talk just a little bit about that. Like, in what capacity are you doing that? How does that fit into this business model of acquiring these units through the blind pool?
Yeah. So I'm not currently a commercial lender. I spent 5 years as a commercial lender.
Perfect.
And part of my growing up, so to speak, right? I think I was a commercial lender in the early 90s, I think, if memory serves me. It was the early 90s. And then I went to Deloitte in 95 and became a CPA for 7 years after that. So that's kind of the way it went. But here's why, your question is still relevant and I think important. Real estate, in the real estate business, we rely on debt. We have what we call a capital stack. It's comprised of, when you buy a property, you're going to have debt and you're going to have equity. Well, we've been talking so far about the equity piece, but most of the capital stack is the debt piece. And it's been really, really helpful for me to have sat in the lender's chair. I've sat before loan committees and tried to get loans approved. I've sat in front of loan committees trying to get lines of credits renewed with customers that every person sitting around the table knew better. They knew the customer better than I did, because I'd only been with the bank a few years. And that, if you're on loan committee, you've probably been there a while, right? You've seen these customers over and over. I've been in the workout side of lending, because they always, at the bank I was at, they wanted you to spend time in workout, because they want you to see what happens when the deal's not working out, and see how that works. So the reason that's relevant is because most real estate investors that I talk to, sponsors, people trying to do this, they just don't understand how lenders think. They don't understand what they're trying to accomplish. They don't understand what risks they're trying to mitigate. They don't understand, why do they keep asking me for all this information? This is ridiculous, right? Why do they need to know this? Well, there's a lot of really good reasons. And so it has helped me shape how I present information to them. And if I understand what they're trying to do, then I can give them the information they want, rather than I've probably heard of people just fighting with the lender all the way through the transaction. And that's just not what you want to do. You're asking the lender to take, in the real estate world, 75% of the risk. Well, it's really important that they really understand what that risk is. And they're banking on you as the management team to take that asset and do what you said you're going to do with it. So they're going to really want to understand you and your liquidity and your net worth and your skill set and all that sort of stuff. So I've been able to use a lot of that experience, along with just the technical side of lending, with interest rate swaps and rate caps and all that kind of stuff that is really just confusing. If you haven't gone through it, it's allowed me to really package my accounting career with my lending career and bring that expertise to the real estate world to just help us do better deals and to help us, do better for our investors.
Yeah, that was a great explanation. And one thing I apologize for is I didn't go back into your backstory to hear, all these different pieces, how they come to you. But remember earlier, I was saying, when you have people on your team, or when you're going to invest money in things like and understand, not things you have no knowledge of, or find somebody that you're going to invest with that has experience or has knowledge through experience, through wisdom. And wisdom, again, is created through time. And I always like to say through failure. So working in that workout section of the bank, you're seeing how failures of loans happen and why they didn't go through. So that makes you an utmost expert. And in my definition, because I'm writing a book called The Laws of Wealth, that is law number 4 that you just described, where you either are the investor in things know, like, and understand, or you're investing with somebody. Your expertise comes through wisdom of time and seeing how these different things happen. One other thing too, I wanted to dissect there, because I think a lot of people are maybe misunderstood about equity versus debt. When you think of debt, everybody thinks, oh, I got a credit card. Well, yes, but let's define that a little bit. When you invest in equity, you're just taking a small fractional share or sometimes a larger share in a company, and you are at full risk of that company. If the company makes money, great, you share in that through the equity percentage you have. But if that company loses money, let's use Lehman Brothers in 2000 in the Great Recession time. If you had Lehman Brothers stock or a mutual fund that had association with Lehman Brothers, you could have lost all of your money because Lehman Brothers went out and went down, and that's equity. Okay. Your risk goes to zero and your upside can be to the moon, as they say today. But debt is different. That is very much, an IOU. Think of a bond. If you invest in a bond with the US government, treasury bonds, they would be called in most cases, you're giving the government money and they're giving you a promise back through a note or different instruments that they're going to pay you back in a specified period of time with a specified coupon or yield, like interest rate. So when you're talking about debt, it's a higher priority than equity, because essentially the company you're lending them money in a roundabout way, and they're paying you interest back with an expectation of your capital being returned at a certain time in the future. So that's why debt typically is viewed as being lower risk. Now, don't always think that debt's lower risk than equity, but in the general sense, it should be. So I just wanted you to understand that there's 2 ways you can invest money. You can do it in equity, which is the way most people do through their 401ks and brokerages. And then there's debt, which debt is, when you lend somebody money, you get paid an interest rate, and then they're going to repay that money in a specified time. I prefer the debt side. It's the world I've lived in, with being your own banker. But I just wanted to kind of do that. And that might've been a long explanation, but I think it's something that a lot of people don't understand. And I think that needs to be understood in order for you to make accurate decisions on how you invest money for whatever project you're doing. Is pick the right type of investment based on your risks and needs and goals. With that being said, let's talk real estate. So Florida, booming market, the whole country, everything's booming, even here in Buffalo, where I don't know why people would want to come here and live. Real estate's through the roof. So we got all this crazy stuff stimulated by low interest rate environment, stimulated by trillions of dollars pumped into the economy, creating asset bubbles. And in your market in Texas, I would also, second, is because people are just sick to death. And when it comes to politics and different lawmaking things in certain states, so they're flocking to the states that are viewed as more open and free. So what do you see happening in the future of real estate?
Yeah, that's a really good question. So let's talk about Florida, right? And why we're there. And it's a demand supply thing that it always, in my world, business always starts with demand and supply. So it's not by accident that we do BC class assets. So BC class assets, think of them as properties that just an ordinary person would want to live in, right? Don't have to be rich. You're not going to be poor. You're just a normal person that you're going to want to live in the asset that we would have. They're not building those types of assets in the state of Florida, anywhere for that matter. And the reason they're not is because they can't afford to. When they build assets now, the cost to build and all of the things associated with putting an asset together and building it, they're much higher. So they can only build higher quality assets, more expensive rents. They have to get $3,000-$4,000 a month in rents. Now that's the supply side. So there's no new addition to supply. Now let's look at the demand side. We know that pre-pandemic, the census has said that 950 to 1,000 people, let's call it 1,000 people, are moving into the state of Florida each day. That's net in migration. That's after you take away deaths and departures and everything else. It's net in of 1,000 people a day. I don't know what the breakup between wealthy people and just ordinary people is, but let's pretend like it's 70-30, right? It seems like a reasonable assumption. About 30% of the people are moving in. They're going to fill those high quality assets because they're wealthy. They can afford to, maybe they want to live in a well amenitized, resort like experience. That need is filled with the builders that are building. But those 70%, that 700 people a day, they're trying to find their way into this BC class asset, and there's no new supply. So you have increasing demand and stable supply. Think back to your econ class. That puts upward pressure on rents. It just has to, right? So I call that a bull market. Now, in our world, we do value add on purpose. So we find assets that if we make them nicer, we could charge more rent. So we're taking the property from here and we're going to bring it up to this level. And because it's a nicer place, we can charge more rent. We're not going to charge as much as the brand new stuff because we're not brand new. But what we're doing is we're filling a need for the ordinary person coming in. And so they want to live in a nice place. They don't want to live in a crappy apartment building. They want to live in a nice place. So when we do that, we're filling this need for this increased demand without any new supply. So when we put our value add strategy on top of the bull market that already exists, I mean, your returns just explode. So when I look at places like Florida and Texas, I get this question almost daily. Aren't you worried that aren't you worried that this is gonna explode on you? And when you go back to demand and supply, I got to find a way to screw up one of those two sides of the equation. And I can't find a way. I love apartments because I can't find a way to replace it, right? I can find a way to replace self-storage or office or retail, right? I can find reasons that those markets would contract in a big way. But unless we figure out how to not need a place to live, we're going to need a place to live. So I love that. So we have a relatively low risk asset, and I can't see them building unless the government steps in and really subsidizes the build process. They're not going to build BC class assets. So I don't see that just getting destroyed, and I don't see the demand side getting destroyed because not only people don't move to Florida just because they're trying to get out of New York, although there is a one-way train, no question about that, from the Northeast, no doubt about it. Florida is a wonderful place to live. I mean, it's got sun, and now people can do this remotely. So now they can have no income tax, beautiful weather. I mean, just there's so many reasons. I've got to find a way for that to get destroyed, and I can't find a scenario where that happens. If I could really legitimately think of a scenario where one of those two things would get destroyed, then I would get worried about what we're doing now. Are we going to continue to see the crazy rent increases? No, I mean, that's not going to happen. What is happening here is we're just getting this massive influx of people because people have now been freed, right? With this remote work, they don't have to live where they don't want to live. They can live somewhere else. So we're kind of gapping up. And I think that we're going to have steady Eddie growth. At least that's what we're projecting going forward. I'm not projecting 20% a year. Don't say that's not going to happen. And if you're projecting that, you're going to be really, really bummed out when you don't get it. But we are going to get 2 to 3%. I think that's very conservative. And I think when you think about your equity being leveraged with that, that's going to produce really good returns over the long run.
So I'll play devil's advocate just because I'm a steward of history and I study history in every economic recessionary or depressionary period. So I love that you said everything you said. It's absolutely correct. Supply and demand. You defined that. You talked about the need. From 30 to 70%, which is probably pretty accurate. And then you're trying to find an upset of those two, and there may not be one. But let's just pretend that 2022 does mark the crash of the stock market. We all know that it's coming. I mean, it can't not happen. And when it does happen, because the government's kicked the can so long through modern monetary theory and printing, some would say unnecessary amounts of money. Right. And now you've got these crazy asset bubbles, but you have a supply and demand. So let's just say market crashes, stock market goes down, 30, 40%. Now, obviously I think it's going to, but we're just pretending here. Mm-hmm. Markets drop. People's 401ks drop, their incomes drop because they might lose their jobs. Companies go out of business, companies scale back, and everything starts to deleverage. And now you start hitting deflation. In your modeling, in your pro formas, when you're looking at a deal, a B or C deal, and you're looking at doing those upgrades, those value adds, how much threshold are you allowing for a decrease or a market fallout that would then maybe force you, because you have to fill units, force you to reduce the rents? So right now you're seeing nice rent increase, but in a market fallout like we had in COVID, there's going to be a period of time, whether it's 3 months, 6 months, 12 months, 18 months, where you might have to make concessions and reduce rents, or, just reduce rents across the board to attract tenants to come into your units. How do you model that when you're actually doing your pro formas?
Yeah, well, we model it through economic vacancy. We just increase economic vacancy to say, okay, at what point do we get to the point where we're starting to get concerned that we're not going to be able to make our debt service? I mean, the lenders right now are requiring us to have 125% debt coverage, which is good, right? You want high. That. Pardon me?
I didn't know it was that high right now.
That's pretty much where it is. Yeah, 120 to 125. I suppose you can find lenders out there that would do something else. But I think generally, I was a student of the 07, 08, 09 recession. I got to watch. I'm pretty sure you really watched it carefully, learned a lot, as did I. So what I'm noticing is that what the lenders did back then, they are not doing now. So part of what happens is, if they're holding the line, before you could get a loan on an apartment building in the state of Florida with a less than a 1.0 debt coverage, and it's because they were underwriting as a condo flip, and there was no chance that thing was ever going to get flipped to a condo, because if you just looked at it, you'd know no one would buy that, right? So just stupid things were happening, and they're not happening now. They're allowing you to pay whatever you want. They're holding the line on their debt. So you want to keep paying more, that's up to you. That's on you. They're pushing. You do that with equity. You can't do it with debt. That is not what happened in 07, 08. So back to your specific question, and that is, how do we model it? We model it through economic vacancy. We take it down to 90, 85%. What happens if we get to 80%? Now, we run our properties always with the number one goal of occupancy. That's number one for us. And that means if we have to reduce rents to stay full, we're going to do it, because $1,000 in your hand is better than not having 1,050 in your hand, right? I mean, it just doesn't make any sense. So we're able to do that. The other thing that our particular company has as maybe an advantage over a lot of our competitors is that our company originally grew up in Cleveland, which is not a growth market. It is a market that demand supply looks very different. Supply is about the same, demand is decreasing. So that means if we wanted a new tenant, we had to go steal it from the guy next door. It wasn't just coming from the train of new people going into the market. So this company, we actually grew up in that environment. So we got really, really good at dealing with that kind of a situation, which makes me feel good, because I know how to manage through it. Because we had to when in the early years of our company. That's why we don't buy anymore in Cleveland. There's nothing wrong with Cleveland. I'm not suggesting that someone shouldn't buy in Cleveland. It just isn't right for us, and it's harder to make money in Cleveland. And so I don't know if that answers your question, but that's how we do it. We just budget down that economic vacancy to figure out where it is. I mean, if somebody thinks that at 95% is their break-even point occupancy, you're in trouble. Do not do that investment, and we wouldn't do that.
Yeah, and I think a lot of investors right now, especially, I don't want to call them rookie investors, but newer investors coming into the space, they see the speculative market, they see pricing going up and up and up on their property. So I think a lot of them have these short-term, get rich quick kind of ideas that I'm going to buy this, I'm going to operate it. I don't care if it's even some syndicators are doing this, where they're really playing the appreciation part of the property as the main focus of how they're operating. And then the rents and the profits are maybe a secondary, or, they can call it an equal, but they're really looking at the appreciation. I think in that modeling, I think those people are in a lot of trouble. I think they're making some terrible decisions. I think if they have investors, their investors should be incredibly concerned, because anytime you get into a speculative bubble like we're in now, whether it's supply, demand, new people moving in, all boats rise with the tide and all boats fall with the tide. Your rents will always carry you. And I loved how you did the modeling of, you're just protecting the downside, saying how much lower could we go and still be profitable or still meet our debt obligations. But I think a lot of people that are modeling on price, and in the appreciation of the asset, I think they're the ones that are going to get stung. They're the ones that are going to get burned really badly. And, I've been sounding the warning bell for years. People think I'm crazy for saying this, but it's just like, if you just study history and you understand patterns, it's inevitable this is going to happen. So when you're getting in the real estate space, get in the real estate space with the right intentions, with the right numbers, and with the right strategy. Otherwise, it could all come crumbling down like a house of cards. And that's not good for anybody. And you're not solving anyone's problem when that happens, because you made the mistake, not, the investor, because the SEC is never going to sit there and point fingers at the investor for making the mistake. It's always going to come back to you, the person who raised the money and the person who's operating. Trust me. It doesn't matter if the investor lied to you. It's your fault for not flushing it out and figuring out why that disconnect happened. So as we kind of get to the tail end of this, if people wanted to invest with you, because it is a unique thing, I love your model. You got a great staff, lots of expertise. You got all that wisdom. How would people go about finding deals? I mean, do you have availability in new deals? I mean, is it pretty much a continuous flow where you can take on new funds? And how do people learn more about this?
Yeah. So the first thing you want to do is get on our list. Right now, we don't have an open fund because I just said we closed our last fund for reasons that I won't get into right now. Where as soon as we finish deploying this, we're opening our newest fund, which I expect to be end of first quarter. So you want to get on our list. And the easiest way to do that is to go to kripartners.com/ebook. And I wrote a book. I wrote it myself. It's Multifamily Real Estate's a Total Game Changer. And it covers two questions that I'm really passionate about. The first is the number one question that every single person faces when they're thinking about real estate. They know, because everybody's telling them everybody's making a lot of money in real estate, and they are, but they have to figure out how it's going to fit in their life. If they're a physician, a doctor, an attorney, or whatever, right? How is it going to fit in their life? So I take them through that thought process to figure out how it's going to fit in their life. And for most people, it means that they should probably be a passive investor. So that leads me to the second part of the book. And my real passion is how to vet sponsors. That's really important because you recall the Jobs Act of 2012 made what I do possible, right? It opened up the capital markets to small companies like ours so that we can talk to accredited investors and invite them into our deals. Prior to that, you couldn't do that. But what comes with that is this area of responsibility where the market has to kind of govern itself. And I believe very strongly that we need to educate the investors to make sure that they know the right questions to ask. I give them some really good insight about how companies like ours operate, what makes us tick, why are we there, what makes us, do what we do, because I want investors to understand what they're investing in so that it helps them make good decisions about where they invest. That's really important to me. And so that's the second part of the book. It's kripartners.com/ebook. Another thing I would encourage if one of your listeners are looking at this, there's a site out there called veravest.com. I have nothing to do with this site other than we paid them a lot of money to vet us. So to keep with the theme that I very strongly believe about transparency, this company exists for the sole purpose of vetting sponsors like us. So we gave them 23 years of tax returns and settlement statements and bank statements and everything you can imagine. And they went out and they did their due diligence on us. And they said, okay, you know what? KRI's track record, here it is. It's right there on their site. They can see it. And so I take you through that process of why an exercise like that is important, because I talk to investors every day, and it's really hard for them to really figure out if I'm the real deal or the investment firm that they're talking to is the real deal. What if the bad deal that they got into, they just don't tell you about? Well, Veravest, I don't know how they do it, but they go out and find public records and they search and they're looking for those deals. How do you know that the guy that you're investing with is following the operating agreement? Veravest monitors everything we do, right? I'm not getting paid by Veravest, but the reason I bring them up is because it's such an important part of this process to be able to really have confidence and transparency with sponsors that I think it's a really useful service. The only thing I don't like about Veravest is that I didn't start it. It is a wonderful idea. I wish I would have thought about it myself, but it's a really important thing for people to look at because it's just another tool. So again, kripartners.com/ebook. It's a free book. You guys like your book. They got to give me their email address.
Yep.
And then you're going to be able to keep tabs on what we're doing. And as soon as that next fund opens, then we can have a one-on-one conversation with them because we require it. You can't just invest without ever talking to us. We want to make sure that we're on the same page and then get in the next fund that we offer.
That was great, Ken. And we're going to put that in the notes, folks. So if you're listening to this podcast or watching this podcast, just go to the description. We'll have that link in there so you can get the ebook and then, make some accurate decisions based on the knowledge. And let me just kind of finish that up with, this book, The Laws of Wealth. I want all of you to remember everything Ken just said throughout this entire podcast. Because remember, we're looking for one or two golden nuggets. And then I want you to understand the laws of wealth. And I want you to then make the connection of how accurate everything Ken said and how in line it is with this law. Here's the law. If you're not first, you're last. Protect your wealth always. Only invest in things that you know, like, and understand. Invest and lend to people or things who have shown, not just said, that they are experts in a specific industry through time, wisdom, and experience, as well as the ability to pay. Avoid unnecessary risk due to greed and impatience. There is no getting rich quick. Time separates the true wealthy and the imposters. That is the third the third law of wealth when it applies. And everything that you just heard Ken falls directly in line with that. And the fourth one just talks about how your money will flee you. This is why most people are going to become broke or poor in the next, fallout, is because the fourth law is talking about how money will flee its owners because they're seeking unrealistic returns and unrealistic timeframes and everything else. So don't go out there seeking unrealistic returns. Wealth is a journey, folks. Wealth is it's a marathon. It's not a sprint. And investing has to fall within these different things. So if you're chasing quick returns, if you're chasing the unrealistic big returns, as so many are in this crypto world and all these things, I promise you one thing, because this is going back before Christ, your money will flee you if you're not careful in protecting it. So Ken, thank you so very much. This was really enlightening. I love that we kind of got into some things we never really get a chance to talk about on this. And I will make sure that link gets put up there so people can read that ebook, learn, and then make decisions. But I would feel very comfortable investing money in your blind pool for the next deal. So please keep me on the list, if you will, for the next deal, because we can invest through the private hedge fund. And that would be a risk category I would take.
Fantastic. Well, thanks so much for having me. Hopefully I was able to add value.
Absolutely. And folks, thank you all for joining us for another episode of the Money School podcast, and we will see you next time.